Well, thank you so much, and I'll probably have to walk back and forth a little bit or get one of you guys to use a finger to advance that. Oh, okay, so if you don't mind sitting there, that'll keep me from walking in front of everybody here. But great pleasure to be here. I normally don't get up at 4:30 in the morning. I usually don't get up until about 4:45 in the morning. Thank you for laughing. Because that's not normal for me. But I did always enjoy coming to Sullivan County. It's, as I always tell most of you, it's home for me. I'm from Clark County, Illinois. We still have a family farm west of here, about 45 miles, something like that, just south of Casey, Illinois, is where our family farm is at. So I particularly like to come and I can see the crops because I know that's just about what it looks like on our farm over south of Casey. So it was fairly early in July when I heard from our tenant in an email. It was really quite a short email. I asked him, how are the crops doing? And he farms with his dad, and he said, well, I think that was the first word, well, it's not a good start. You know, well, pause. I think the corn's pretty well gone. And then the next line is, here's the insurance that we have on that crop. So I haven't followed up. I mean, maybe overly pessimistic to say it was gone, but certainly been a rugged year without question. We're going to look at that year just a little bit in terms of some of the measures that we have to try to give us a sense of how bad this year was. Of course, that's one of the things people in the media like to know, and just unbelievable number of calls from New York City and working with the national networks to try to get some farmers to talk to here in Indiana, and people around the world wanting to know what's it like in Sullivan County, Indiana. I didn't want that specifically, but what does it mean? What does it mean more broadly for the world in terms of food consumers and fuel consumers? So I'll try to show you a few pictures of some of the measures we look at in terms of the extent of this drought this year. Give you a little perspective. Out of 100 years, how many years would you expect to have like this? And all of you around agriculture say, I hope no more like this in the next 100 years. But we have some measures here, and we can talk more broadly about some other measures in the years we look at. Most of you have heard and are familiar with those years, but the most recent was 1988. That was a broad drought across the Midwest. And so this one is actually now tracking fairly close to 1988. These lines represent some crop conditions reports that USDA turns out every Monday afternoon at 4 o'clock. And what they do is enumerators for USDA all around Indiana and all around the primary corn, soybean production states are watching the crop. Now, the watching of the crop is primarily what I call a windshield survey. You know, as they're driving through the county, maybe it's the county extension educator, as Lori is representing a number of those help out. Are you do that, Lori? Okay, for USDA. Okay, so we have a number of our Purdue extension educators that supply information. So they rate the crop in their area in 5 categories: very poor, fair, good, and excellent. So we take those and we can build them into an index. And these are the worst years since that system was set up back in 1986. So this drought is, historic magnitudes of the second, third, fourth, maybe first, second, third, fourth worst drought in 100 years. So we're looking at something, 1%, 2%, 3%, 4% odds. We don't know the final extent of the damage to the crop. is. We don't know for sure. And when the season gets wrapped up, in terms of yields, we'll be able to say, okay, this one ranks exactly where. So one comforting thing, I get those calls, you know, from urbanites, and they say, well, you know, I've heard about global warming, and I hear global warming is going to turn the Midwest into a desert. And is this an indication that now has happened, that mankind has changed the environment so much, and we're going to have a desert? Nobody's ever seen anything like this, right? Yeah, well, we have seen things like this. And we know 1988 is a similar magnitude. And then we had a couple years in the 50s, 54, 56, very dry through the Midwest. And then we go back to 1934, 1936. So at this point, we're about like 1988, maybe somewhat worse than 1988. So then that takes, well, I look at things back to 1936 and 1934. In 1988, we had about a 25% reduction in the national corn crop due to the drought. That's about what we're looking for USDA tomorrow morning when they release their information on the first estimate of the size of the crop, about a 25% reduction. The 1934, 1936, those were around 28% reduction in corn yields from what we were expecting in the spring. So I don't think we're quite to the 34, 36 years yet, but I think we'll probably be close to or exceed in difficulty 1988. And so if you think back, and then the previous one to that was 1902, we were down about 30%. How many remember that year? 1902. A couple of people in the back. Yeah, okay. So we do have something this year that is a fairly rare event. On the other hand, it is within the observation set of the data that we have. So I think we try to lower those environmentalists who are throwing out statements. Now every year is going to be like this in the Midwest. No, we've had these before. They don't happen often, thank goodness. But and we don't have any real indications that the Midwest tends to have droughts that just hang on year after year after year. Now maybe Texas, the southern plains, they tend to get into droughts that hold on for years. We know the mid-50s was a time when we had a series of years that were dry. We know the mid-30s was a period when we had a lot of dryness. But in the mid-1930s, 34 and 36 were the difficult years. 1935, U.S. had perfectly normal corn yields in 1935. So I think what we have to say is there's no tendency in the Midwest from our historical data to say because you had a drought this year, you're going to have a drought now for the next year and the next year and the next year. So again, it certainly is a bad drought. Okay, so here it is this year on these ratings. Basically, an index here of 2. I start with 100 would be everything. This is Indiana. Everything is very poor. Very poor is the worst category, and certainly you've had some of your crops in very poor in Sullivan County. Some that won't be harvested, some of the sandy soils that are not going to raise any corn. They're certainly very poor. 200 would be poor, everything rated poor. Now again, there's 5 categories, so we take an index and put that into an index. So here's the 1988 crop. A little hard for you to see the dates there. This is bottomed out in 1988, about middle of July. So as we got into the last half of July in 88, we started getting some rain and things started to improve. This is corn, this is Indiana. You can see this year then how we pretty much paralleled 1988, maybe falling a little faster than 88 in here. And in 88, then by the last half of July, we started to get some improvement. And this year, what has happened in Indiana is the last 1, 2, 3 weeks, we've kind of stabilized. We're still falling a little bit, but much more stable. But the point there of this data, these crop ratings, this is the worst year that we had. That started in 1986. These are just the bad years. The good years are up there, you know, so I don't even have it. So worse than 1988. Soybeans, here is 1988. And you can see again, as we said, when we got into the last half of July, we started to improve. We kind of went back down as we got into later August. But these circles are where we're at this year, substantially lower than 1988 on soybeans. Now again, what is going to happen with some rains that we have had on the soybeans, and some of you, as Howard has mentioned, some of you did get some rain last night, and for the most part, the beans are still green. If they're still blooming, the yields can be improved and can be helped. So we might have a sense here as we go to next week's report that we not only have stabilized, but we could see that move back up. Okay, that's Indiana. So we're both corn and soybeans below 1988. This is the nation for corn across the whole country. And there's 88, and here is this year. And again, you see the parallel nature with one noticeable difference, and that is that the drought in 88 set in about 2 weeks earlier, and it ended about 2 weeks earlier, maybe 2 to 3 weeks. So we see this pattern this year. When we're dropping, that is about 2 weeks later when we reach roughly parallel situation. So as I said, the 88 drought about mid-July, it did abate, it did get better. A lot of damage was already done, particularly on corn. This one's about 2 weeks later. And again, you can see nationally, we are still falling. Indiana was the worst of the states, major states early this year in June and early July, and then the further west, particularly Illinois, and then moving to Iowa, Nebraska, obviously Missouri was in that, Kansas was in that. Those states really are what has led us in late July into these low levels. Okay, so right now the corn crop is rated nationally about the same as 1988. Okay, let's look at the soybeans nationally. Soybeans nationally, here's the 88. We already had an improvement. By late July, we started to go down a little bit into early August. And you can see this year, we are already on soybeans are below the 1988 ratings. But, these rains that have come through Indiana, generally, Iowa got some rain, Illinois got some rain out of that. And so I think it's reasonable to expect we're going to see a tilt back to the upside next Monday when this next report comes out. But you see kind of the magnitudes. I do estimates on the crop size. These numbers will be a little hard for you to see. But using those crop ratings, we started out here in early June, around 166 bushel national yield. My estimate this last Monday was down around 128 bushels, and the guesses for tomorrow USDA are around 126 bushels. So I think my numbers are reflective of what is going on, how we have lost from week to week to week. Indiana numbers, I'd start about 166 bushels, and I'm around 118, 119 bushels, approaching a 30% loss here in the state in terms of our corn crop. Now again, the corn, talking about the state, is that really important to any one farmer in here? What happens to the state? And the answer is actually that doesn't mean much to any individual producer. What really makes a difference is what happens on their farm, and we're going to look at some of those results. soybeans, the national number I have is about 37 bushels per acre. That is down from around 44, down about 16% actually. And the estimates for tomorrow are 37.2 bushels. So we're pretty close there, down around 16% on the national crop. And I've got the Indiana crop down about 19 or 20%. So what this is saying is Indiana is hit more severely than the nation in total, and that is a bit more negative for us. We have less bushels to sell on average compared to other farmers across the Midwest. Sometimes, as Howard said, it comes to your farm. Sometimes this does happen. Okay, Laurie? All right, so let's talk about, as we talked about the drought. And there's just no question. This is the, we can't get all these numbers into perspective. We don't know how bad the yields are going to be. But the impact of the drought is tens of billions of dollars. I think we're probably going to be $80 billion across the country. That could go $100 billion, but it's really too early to, we're still in the process. We're working through to see how this is going to end up. So it's a pretty big deal, and it's a pretty big deal when it's focused on one issue, agriculture. So it is the drought that has caused the losses. But when we think about the financial losses, we're saying something here that surprises people. And that is there's really two factors. While we have one of the worst droughts in 100 years, one of the worst droughts in 100 years, the financial consequences for the entire crop production sector in the United States and in Indiana is not going to be one of the worst financial years in history. Wow. Now that, hey, I haven't had a bad year in terms of yields, but what are you talking about? Okay, I'm talking about the whole sector, crop sector in Indiana, or the whole crop sector in the United States, or if we're talking about corn. Corn production in Indiana, corn production in the United States. And there's two important reasons for that. One is what we call the natural hedge. What's the concept? The concept is that if we have a major event, as we've already talked about, this is a major event, and it's in a wide area, like a drought, exactly what we have this year, then you really reduce national production, and what happens to the price? The price goes up. So this is really, really big on corn. As we've already said, we think national production is going to be down around 25%. And, USDA will be out at this time tomorrow at 8:30. We'll know what that number is, so don't hold me to exactly 25%, but about 25%. Production is down 25%. So far, the price of corn from where we were pre-drought, I go back to mid-May, when we still are pretty optimistic about getting a normal crop. Production's down 25%, prices are up 60%. As you stop and think about that, wait a minute, I have 25% less to sell, but I can get 60% more for it. On corn, those numbers come out about $20 billion extra dollars across the corn crop. The corn crop today is worth $20 billion more nationally than it was back then we expected it to be back in May. The corn crop in May we expected nationally to be about $75 billion. That crop's about $95 billion. Man, don't you love that? Okay, so we're starting to smile. Either that guy's crazy, or he's going to tell me about something I don't know about here. corn production sector bad year at all. But within that sector, within corn growers in Indiana, within family farms within Indiana, oh, you talk about differences in how this year is going to work out. I'll just give you a little bit of a feel of that here in a second. That's going to be from big negatives and bankruptcy all the way to people who only in the secret of the night are going to say, I have had one of the best financial years I have ever had. This drought has really paid off for me because of certain decisions that I made earlier about this drought. I'm going to tell you what those decisions are. Okay, so this, we got to look at the natural hedge and the fact that if I had a half a crop, I mean, you've got to be losing money if you have a half crop. But what if you could sell it for twice as much? Okay, so you see the impact of having half a crop. It's not 60% on corn, so not twice as much. But that's pretty substantial. Okay, and of course the other one that most of you have heard about is crop insurance. So crop insurance, as I said, on the natural hedge on corn, has increased the value of the corn crop about $20 billion across the country. That's on a crop that's $75 billion expected this spring. Crop insurance, we're going to talk about all crops here. So this will be corn, soybeans, wheat wasn't heavily affected by the drought. So it's really heavy corn and soybeans. But the payout on insurance this year, we don't know what it's going to be. But some guesses are around $30 billion of payout across the country. Most of that will be, the biggest chunk of that will be on corn. Will be the biggest payout will be on corn. Any of the bonds. Corn's the biggest crop. It's the biggest value crop. It's the one that's most affected by early season drought and into the summer drought. Okay. So we start thinking about that, and we start to say, these are some really, really big offsets to the loss of yield. Okay, let's move ahead and talk about these just a little bit. Numbers are a little bit small here for you to see. I'll try to point to them. I'm going to start with trying to illustrate this for the state of Indiana, the natural hedge. And I'm going to start back on May 15th. Just because May 15th we had the corn pretty well planted, we were on to the soybeans, and maybe even had the soybeans pretty well planted, and you know, we were pretty optimistic about where this crop was going to go in terms of production. So we'll go back to that time period. I've got my expectation on Indiana yields about 166 bushel corn. At that time I was using $5.10 a bushel average Indiana farmer selling price. So we can pretty quickly look at the arithmetic. 166 bushels at 5.10 would give us a revenue $846 on each 1 acre on average across the state of Indiana. Now today, I'm using 119 bushels, a 28% drop on the Indiana corn crop, and it may be a little bigger than that, but just look at that number. And corn's a bit over $8 now, but I used a 760. 119 bushels, 28% down. Price for Indiana farmers up about 50%. Revenue higher revenue on what the average farmer in Indiana produces than what we would have expected in Indiana. Wow, this is pretty cool. Now, that works as long as what? You're one of those farmers that's about average. What do we say about the farmer that isn't average and has a much more severe situational drought and raises zero? Okay, now what is 0 times $7.60? Golly, that's still 0. Yeah. That's what I could always get on math in high school. Maybe that was junior high. 0 times anything still is 0. So again, this is a big picture of the sector, but it's not speaking to individuals. If you are a banker in this community, you've got to go out there and you've got to talk to individuals. And if you're trying to do things to be helpful to people who may be in stress, financial and emotional and personal and family stress. I can't look across this room and the farmers I know in here and tell which one could be financial difficulty. But we can give you the conditions. And I'll get to those here in a second. I can give you the conditions. If you're in this situation, this situation, and this situation, this could be a really difficult year. And even for some, if they don't have a strong financial situation, could be some bankruptcies. Okay, now, one of the things nobody's called me on yet, I guess I haven't given you a chance to call me on this, but that is, some of you probably don't know this, but farmers can, say like in the springtime, they can forward price some of their corn, soybeans for fall delivery. Now, we're talking about the natural hedge. Lower production raises prices, big benefit on the higher prices. Production goes down 25%, prices go up 60%. What if I forward price my crop back at the low prices in the spring? That's one of my categories that I'm going to ask to identify. People who aggressively forward price. Example, my tenant said, I followed up after he said, I said, how's the crop? He said, well, we think it's about gone. Here's the insurance. And I followed up then with another email. How are you with regard to your forward price? And he said, well, and he emailed me back. I could see the tears that had dropped on the email. He dropped tears on the email. How do you do that in an email? Show the tears are falling. And he said, I forward sold 60 bushels to the acre at $5 a bushel. He didn't give me the details, but I know what the markets were when he was doing it, around $5 a bushel. I sold 60 bushels. I had already bought half of that back. I bought 30 bushels of that back. Corn was not $5, it was $7. So I've already paid the grain elevator where I sold 30 bushels. On the 30 bushels, 60 bushels, I bought 30 back, and I paid the grain elevator $2 a bushel for every bushel I bought back. So that's for every acre I did this on, which was almost 2,500 acres of corn. I paid 30 times $2, $60 an acre. I wrote a check. I not sold anything. I wrote a check. And then I have 30 bushels still to deliver, and I don't think I'm going to be able to average on 2,500 bushels of corn, 30 bushels to the acre. And so what I'm going to do is, I'll show you here in a second, what he's going to do, in drought years, you tend to get the beef prices come around the drought, and then actually prices tend to go down and start working down to the next crop. They peak early around the drought, and they have a long tail headed down to the next crop. So I'm going to wait until after harvest, see what I have, and I'm going to probably wait until maybe November, December, when those prices come down some more, I'll buy that, figure out what I need to buy that. Okay, so here's the category that just doesn't work for individuals, but they were aggressively forward contracts. So I went in here under another line here, I assumed 20% forward contracted at basically $5 corn, and that's 20%. And that reduces my revenues on corn, where I'm actually about 3% less than what I expected in the spring. But even with 20% forward contracting, it doesn't drag me horribly down. And again, this is given a 28% drop in yield and 49% price. Same kind of stuff over in soybeans. The natural hedge has not been as strong there. Soybean prices are not up 60%, they're up about 20%. Several reasons, but one reason is the market participants have continued to know that if the rain came, how many times did we say, we didn't get it this week, maybe next week? Until you finally get tired of saying, after 8 weeks of this, it's not coming. so bean prices have not been as strong. So there's not as much positive advantage, but still the devastation is not nearly as big. I got 11% lower revenue on beans, 3% on corn, even 20% forward contracted. And so it's not devastation if you're about the average. Okay, let's move forward. So let's look at price patterns. We're going to talk about that. And I'll talk about this in terms of 1988. You've seen the parallels to 1988. It is the closest analog or analogous year. And we go do this sometimes. You always go back and try to think, when is this event, something like this happened, and let's look at those years. So here's a price pattern on corn futures, December corn futures. And the blue line is 1988. This is April, the past April, spring, May, June, July, August, September, October, November, December. So I'm looking at the December futures price. Now, those of you around the farm know that in 1988, corn was not $8.50 a bushel. So what I've done is I use the word forced the 1988 price pattern to be prices similar to this year. The green line is this year. So what I did in April and May, I went back and looked at what has this year's December futures been, and then I forced the December futures to be the same for 1988. And again, it's just kind of amazing the parallels that we have. We said in 1988 the drought started earlier, the impacts began to show up in price about 2 weeks earlier than they did this year. The decline in the crop was similar in 88 as it is this year. The rise in the price in terms of how quickly it was going up, these are daily observations on price, are similar. Unfortunately, I did this, I don't know, about the 25th of July, so we've had a few more days here. We're about 8:13, 8:12 on beef corn here this morning. So we have taken out that $8 high. And, but we can look at 88 pattern. The 88 pattern, we peaked around the drought, we fell fairly sharply, and then this generally long tail starting down. Now the reason for this, we bring this up because this is a heck of a year, and we're kind of getting into the marketing side of things for those of you in the production business. If you have a revenue product for crop insurance, and you have the harvest price option, that harvest price option will be determined in October. And it is what is the average price during the month of October of the December 2012 corn futures. So we bring this to light to say that the price pattern we would most likely expect is the peaking of the price around the drought period. As we peak yet. Again, I think there's evidence on corn we probably have not peaked yet. But when will that peak come? It comes around the time the damage is being done. So the damage and the realization of that damage, I think we are getting close to that period. The odds are fairly high in the drought year. We're going to peak out on price sometime in late July through mid-September. Gosh, that's where we're at right now. We're in this period. So we would kind of say, hey, you want to think about some pricing. So, oh, man, I don't know what I've got. It's hard to make decisions, but we want to think about some pricing down here over the next 45 days probably. Another thing you want to think about on your crop insurance is the possibility of hedging in high prices. Now, again, this is a little more technical. Some of you won't mean much to you. But you can see the difference of the highs, $7.50 to $8.50 on the blue line. And in 88, that December futures And the way I enforced it, $6.72, $1, $1.50 over. Now that is what your revenue, for your revenue protection, if you have a harvest price option, that's what it would be based on. So this leads to some thought, and one of the things I could do on some of that corn, I would get less insurance payment. See what I'm saying? If corn's futures are $1 lower, $1.50 lower than they are now in October, I can lock in these prices at a higher level. If they go down, selling futures or buying put options to take advantage of that decline, that could work. Okay, that's a concept. All right, let's go ahead and look at soybeans. So soybeans did the same kind of thing, 1998 pattern, forced it into the April-May time price, and we got up around $18 to $19 soybeans. Now, beans are in a declining phase. We've gotten some rains. The general view at the trading in the market is that, well, bean yields are going to come back a little bit. And I guess I'm still not convinced, you know, our $17+ beans have really peaked out on this market yet. We are in a bit of a decline now. I think we still have potential to see soybeans in the $18, $19 range, even $20. I think demand's going to be very good on beans. But anyway, go back and look at the beans. Here we had some highs, $17 to $19. But when we got to the November futures, as it was priced in October, $14.65, not $17, $14.65, a couple bucks lower. Okay, does that make sense to you? Fine. If it doesn't, you can look at the colors. Okay. So if I had to identify farms that are going to be in financial difficulty, and I'm not that maybe have the personal finances to get through this, but ones that could really lose a lot of money. Here are the questions I would ask. Okay, what are your final yields going to be? You don't know, but for some people in here, they might say, well, it's fine to talk about a national crop, the corn down 25%. Mine was down 75%. We already said, the closer you get to zero, the less the ability of the natural hedge to work. And so, if you have really low yields, there's just not on the natural hedge the higher prices are not helpful. We've already gotten to this point a little bit. How much did that family have forward contract? You know, this is just a really big deal, and it can make a lot of difference financially. And we'll have a little more demonstration. I haven't talked much about crop insurance, other than to say there's going to be a lot of dollars of crop insurance, and it's going to be the biggest amount of crop insurance ever paid in terms of the claims that are made this year. Some early estimates, as I said, $30 billion across the United States on crop insurance. Within crop insurance, then, there is this opportunity farmers had, if they have a revenue product, to elect, do I want to take the spring or late winter price guarantee, what was about $5.63 on corn, or the harvest option. So what that insurance protection essentially does, it says if you pay a little bit more and get the harvest option price, you can get the higher guaranteed revenue of the spring price or the fall price, whichever one gives you the most protection. On corn, this is a big deal. 60% higher prices, $5.60 versus what looks like to be something more like $8 or $8 plus, something in that range of portion. Okay, that's a lot of difference on the insurance guarantee. And then one we haven't gotten to yet, and that is livestock. So as those reporters, you know, want to know, well, what's this mean? What does it mean, the poor grain farmers? And I say, well, there's actually two things that will help the crop set the big picture. Natural hedge, crop insurance. The livestock industry does not have any protections in the short run. We're blessed to have milk this morning. A gallon of milk, don't know what that costs. but I don't think that gallon of milk purchased for us this morning was any different price than it was 2 months ago before the drought set in. What does that mean? The dairy farmer who produced that milk is still getting the same price for their milk at the farm, but what about their costs? Their cost for feed, for corn, soybean meal, and forage has gone up dramatically. So your revenue you're getting for your product minus your cost, that's your margin. What happens when your revenue doesn't change, but your cost gets pushed up sharply? And at this point, our cost for those milk producers, pork producers, for beef producers, their cost is above their revenues. What's that called? Losing money. Oh, 4-letter word. Still in the money. Okay, so livestock farms, animal producers have no way to recover in the short run. What happens? What happens to livestock producers is they just lose a gobble of money. And you know, along about October, they start saying, you know, this just really isn't fun. And now when is corn going to get back down to $5? And they think about that a little bit and say, you know what that's going to be? That's another year. That's October of 13 when we have another crop, assuming it'll be a normal crop. I don't like losing money this year, let alone every month for the next 12 months. I don't like this at all. And my banker doesn't like this at all. So this discouragement causes some to do what? Either trim the herds or a few may just get out altogether. Now, over the process of this fall and winter time, as we trim the herds, as we get our supply reduced, guess what? There's going to be less milk out there someplace in 2013. And if there's less supply of milk, you know the old laws of supply and demand, less supply probably means those prices at the grocery store are going to go up, and then that farmer can get more for their milk, and that will continue to occur until they can pay $8 for corn. So you and I, the drought is going to cause, many of you had major losses, but you and I as consumers across this country and the world will ultimately pay for all of these losses that the drought has put to us. So what happens to the livestock producer? Let's just think about this. Some of our farmers here in Sullivan County, their yields are much lower than the nation on average. That's bad. Some of them may have forward contracted half, 30%, 40%, half of what they expected to produce. That's bad. Some may not have crop insurance. We think 65 to 75% of the acreage of corn and soybeans in Indiana have some form of crop insurance. Say it the other way, 25 to 35% of the acres do not have crop insurance. There are some in the county who do not have any protection. And that goes with crop insurance, and the final insult could be they also have 300 sows for the finish. They didn't raise enough corn to feed their hogs. Hogs are now losing a lot of money. They have to go into the market and buy $8 corn, which is a horrible loss for them, and they are in deep financial trouble. Okay, there's the capitalism. So here's working through some of the numbers, and this is just a crop farm. I didn't stick the livestock farm in there. And I don't have all the assumptions, so I'll tell you. It's a 500 acres of corn, 500 acres of soybeans. Okay, so some of you, hugely bigger than that. Some of you, that's fairly size. Some of you are smaller than that. Just crops, 500 acres of corn, 500 acres of soybeans. As we went in, and I'm also assuming this is a person who cash rents. So they're paying cash rent and a lot of dollars invested in that crop. So we'll just go to the bottom line. Going back to the middle of May, I was projecting an income for that farm on their crops, $62,500. Okay, family living expenses, that's a pretty good year if we have that kind of an income on the farm. The next column, I'm saying if their crop is 35% lower. I think that would be common in Indiana to see a 35% lower crop. No forward contract, no insurance. And of course, what this does, I've got 35% less to sell. I didn't forward contract. I do get the higher prices, but I have much less to sell. And that drops that income from $62,000 down to $14,000. So we're just about to break even here. $14,000, probably not going to get that new four-wheel drive pickup this year on $14,000 of income. And I'm not sure what you can get on $14,000 of income, but I think food stamps would be one of the things you could get. So we know this is pretty dismal income. But it can get worse from there, and it can get a lot worse from there. For this same farm, or maybe you could think about 2, 3 farms here, they made some different choices. But in all of them, we're going to take the crop down. These last 3, we're going to lose 35% of the crop. We're going to have 65% of normal. But in this column, I assume they forward contracted 35% back to $5 corn, $13 beans back in the spring. That's the only difference. They have no insurance. They have 65% of a normal crop, but they forward contracted. They now end up with a loss of $63,000. They started the year expecting a $60,000 plus income. One decision, the draft and one decision. I want a forward contract, some of that more, about a third, just to make sure prices go lower, I can at least get that amount. That's $125,000. This is not a big farm. We've got farms in there that are 3 and 4 times this. So you're dealing with hundreds of thousands of dollars. And then the last one is just to show the implications of crop insurance. I assume they bought a 75% policy coverage, covers 75% of their yield. Not about 85 is about as high as you can go. 65 to 85%, I assume, the revenue product. And I assume that they had the harvest option. So what they collect on insurance is the higher prices for the fall. That adds that crop insurance check. On a relatively modest farm, 1,000 acres, that's $100,000 plus check from crop insurance. And that's not the highest level of crop insurance. So that would bring them, under this condition, back up to an income of $120,000 this year. Okay, wait a minute. We started out with an expectation of $60,000 of income. What's the last column showing? They doubled their income they expected in the spring. Man, drought is great. Bring it on. There is a situation where, under the right set of conditions, that they make. They didn't forward contract. They have a relatively strong insurance program. They actually come out ahead because what they do have, they're selling at higher prices. And I can't sit here and look at each of you and say which one of you is in which of these conditions. And the banker is one of Miami. Which one of you is in which one of these conditions? So crop insurance is absolutely huge. It is just enormous. Benefits that can happen. Okay, so what this says is, if you look at the big sector, and I look at the New York Times, what does this mean for all crop producers? Now I have to say, it doesn't mean a big financial loss. Well, what does that mean? It's got to be a huge financial loss. Not if, under the conditions we have, with 65 to 75% of the whole sector, with some crop insurance and with much higher prices than actually. But when you're looking at individual farmers, what we call the distribution of that income is going to be all over the map. From horrible minuses to the best year we have ever had. Let's have a drought every year. And that's hard for people to grasp. Now again, the insurance system, insurance program is not designed to make farmers better off. is a big increase in the price that's occurred. And if you have that full price opportunity in your insurance, that's what's really kicking in. This may get looked at in Congress. This is a federal government program. Farmers pay a portion of the premiums, and the federal government pays a portion of those premiums. Okay, so I think this kind of helps you to get a sense. It's not everybody, certainly some, but not everybody. Okay, okay, let me just look at, this is the 1988 futures pattern, but I'm going out to the following July futures. So this is the 1989 July futures, a year out. So what we can see there is not just the drought period here in July and August, but September, October, November, thinking like going into Christmas this year, January of 13, February of 13, March, April, May, June, July, going into next summer. And the reason we look at this is to say, well, an analogous year, the pattern of prices will depend on what happens now in the next 12 months. But we can at least go back and look at a similar drought here. Peak prices coming around the drought, fairly big sell-off, and then that long period, some ups and downs, but that long period of prices coming down as we start to go to next year's crop. Now that'd be on into August, September to get us to the 13 crop. And so this is telling us if you have anything to price, would you rather hold on to that and price it next May or June, or would you rather be pricing that early? Okay, at least gets us thinking. It may not be the pattern this year, but the traditional drought pattern, peak around the drought, come down real, make just kind of an inverted V up here at the top, and then the long period overall head down. If you return to a normal crop next year in the United States, we're going to see substantially, we're going to see the biggest drop in price from this year, the 2012 crop, to the 13th crop ever experienced in the history of farming in the United States. Okay, soybeans, oh no, this is corn. I just added the pattern so far this year. And again, we've gone on up and made slightly new highs. Okay, that's the grain. Soybean, oh, these are cash prices of corn. So let's see where we're at here. Here's the drought in July and August, and I put these on an index, but from the spring being 100, you get prices moved up about 60%, came down fairly sharply, and then cash prices generally work down a little bit also. Okay. So here's my numbers for tomorrow and 2013. And again, sorry they don't show up. I should have made it much bigger. Okay. Here is the 2011 crop, and here's the 2012 crop. So production last year, production this year, we're going to be down about 1.4 billion bushels, and our total supply is going to be down about 1.5 billion. Our usage rate on corn is currently, for the 11 crop that we're finishing marking, about 11.6 billion bushels, and we can't use that much. We only have a crop of 11. So we're going to have to cut back around 1.5 billion bushels of corn use. There's not enough out there. We've got to cut back. I've put my guesses on who's going to cut back. And we'll start with the ethanol industry, and I've got the ethanol industry cutting back just a little bit, about 4% cut, just a little bit. The reason for that is that the ethanol industry now uses, the oil industry uses ethanol to get their octane level higher in gasoline. So they blend 90% 84 octane that they make out of the refineries. Like Robinson, Illinois, refinery at Robinson. And it's one cell at Lawrenceville still running. Used to be Texaco. Gone, closed. I need to visit more. But I don't go across the bridge very much there to find out what's going on. Okay. The Robinson still going, right? Okay, so they're making 84 octane gasoline. They blend it with ethanol, which is 115 octane, and they So what we're finding as we talk with the oil executives about their cost structure is that they are not going to move off of their blends unless ethanol gets substantially higher than the cost of wholesale gasoline. Now, I watched this weekly, and last week I watched Iowa plants. Iowa's our biggest ethanol producing state. Iowa ethanol was 40 cents a gallon under gasoline prices. So until corn gets high enough, and therefore ethanol gets high enough to go above the price of gasoline, and we don't think it's just to the price of gasoline, we think it's actually substantially above it, before they're going to change their volumes. We don't think they're really going to change very much. They're going to use the corn. So I've got them cutting back just a little bit, 4 or 5%. Our food, seed, and industrial, high fructose corn syrup, corn starch, corn flour, corn meal. It doesn't cut back much. I've got just a tiny little bit, about 2% cut back. And our foreign sector will cut back some. I've got them about 8%. So there's the cutback. 17, 18% cutback in the end user known as the livestock industry. So the livestock industry is going to be called upon to make the biggest adjustments, reduce the size of their herds and flocks, to take these big losses in the short run next year, and then when they get their production down, in late 13, 14, 15, you're going to see higher retail prices on those food items like beef, and then they will be able to pay the higher prices of beef. By late 13, you're going to have much lower beef prices, and probably very good profits from the livestock industry, late 13, 14, and 15. Now here's the dilemma I'm looking at for next year, 2013. Corn prices are $8 now. There's still new crop $6.50 for 13. We're going to see more corn acres, maybe 100 million corn acres next year. 96 million this year, push that up. My number's about 3% higher, near 100 million. With normal yields, you're producing around a 15 billion bushel crop next year. We're producing a 15 billion bushel crop. 15 billion, our usage base, total use is about 11. 15 billion production, so a year from now, you can hear this talk, what are we going to do with all this corn? This year, we're trying to get people to cut back, cut back, cut back. Don't use it. You know, it's too expensive. A year from now, we could be saying, use corn, use corn, use corn. We can't get enough users to come into the market. But wait a minute, you just got us out. You know, once I get rid of my cow herd, once I get rid of my dairy herd, once I get rid of my sows, I don't just snap my fingers and say, suddenly, I'm back in full production. It takes time to build that demand. So this is the concept economists talk about, demand destruction. What does really high prices do on grain? It destroys part of your demand. How do you get it back? You convince those end users, what I got to sell your corn is going to be cheap, and it's going to be cheap for a long while. Okay, so let's go cheap. So we've got the ethanol industry. Again, that's mandate. We're not going to do much more, about 5.2 billion bushels. The food will come back a little bit. Exports should come back a good bit. I've got a bunch plugged in here. 22% coming, 23% more feed usage. And I've still got a 2.5 billion bushel carrot. That's trouble. USDA's projections this May, 1.8 billion bushel carrot at $4.60 is what they were projecting in May. So I've got corn prices out here for the fall of 2013, $4.50. Now, I don't know if that's in the ballpark, but what did I say? Possibly 7.5, could be a little 7.75 this year, falling $3 for next year. Now we're looking at next year. Now my vulnerability, all these high prices down, making it vulnerable for the 2013 year. futures is, as I said, about $2 higher than that right now. But we got longer than that. Okay, let's go get finished up. Here's the price pattern. I guess it was last night I did this on corn, August, September, October, where we're at now, going into the end of the year. This was a ethanol plant bid, central part of the state. So you have to look at your numbers, they might be slightly different. So nearby corn, $8.50, really get towards harvest, 8 to 30. And then just pretty flat all the way until getting into next spring, and then there's the beginning of the much lower prices for the 2013 crop. That goes out through next August, a year from now. Okay, so some things really that price pattern tells us. High prices early. You know, there may be some corn in some of those fields. There may be some early harvest premiums. Aflatoxin, dry years, the grain industry is going to be looking for that. What about some incentives for storage or drying incentives? The bottom line this year is there going to be enough storage space for this crop. This is good. That's my thing, that we don't have to worry about that, do we? There's going to run out of storage space. The supply of storage is huge. The demand for storage is tiny. Okay, what do you have when you have a big, huge surplus supply of something? It's not worth very much or nothing. So you can see grain elevators offering free storage. Free storage, you know, that's a deal, isn't it? Free storage, how long will you give you free storage? You give you free storage for 8 months, 9 months, after next August. Why aren't they nice to me? They're going to tell me that I can put my corn in storage here, let's say late September, October at 8:30, and then if I store it all that time, it doesn't cost me anything at the grain elevator, and I can sell it later at about 50 cents more. Well, that's a great deal, isn't it? When you get something for free, you better take it. Wait a minute. Have you ever heard all free lunches are free? Okay, so there's a free lunch that costs you 50 cents a bushel. Right? You want to think about that. So if you're storing corn, if they offer free storage at the grain elevator, and let's face it, who's going to use the grain elevator? Because you got on-farm storage, and you don't even have enough to fill up your own farm storage. Okay. So this is a scenario that's really looking at. This is the probability of getting good returns from storage is pretty low. Now again, if it's free, I don't mind talking to you about the possibility that storing short-term or wait into the winter to see if China comes in and buys a lot. Okay, that's fine.